Question 1. Topic: Risk management and underwriting. An association captive is assessing its potential exposures and decides to set aside reserves for catastrophic risks. Which of the following approaches BEST reflects sound risk management principles for this situation? A. Allocating reserves based solely on historical claims data as it provides the most accurate risk prediction. B. Establishing reserves based on actuarial analysis combined with stress testing for extreme events. C. Using industry-wide loss ratios without adjustments as they represent average risk exposures. D. Minimizing reserve allocations to maintain high surplus levels for other uses. Answer: B. Establishing reserves based on actuarial analysis combined with stress testing for extreme events. Explanation: A. While historical claims data is valuable, relying solely on it can overlook the possibility of rare but severe catastrophic events. B. This is correct because combining actuarial analysis with stress testing ensures that reserves account for both predictable risks and extreme scenarios of best practice in risk management. C. Industry-wide loss ratios provide a general benchmark but fail to capture the captive's specific risk profile. D. Minimizing reserves undermines the captive's ability to cover large losses, violating principles of prudent risk management. Relevant rule: Florida statutes and sound actuarial principles require captives to maintain sufficient reserves to ensure solvency under extreme conditions. Question 2. Scenario-based question. Topic: Legal and tax considerations. Maria runs a healthcare company and wants to establish a captive insurance company in Florida to manage her company's risks. During the application process, the Florida Office of Insurance Regulation identifies that Maria's proposed business plan lacks a detailed investment policy. Additionally, the proposed minimum capital does not meet statutory requirements. What should Maria do to proceed successfully with her captive formation? A. Adjust the business plan to include a detailed investment policy and submit proof of adequate capital to the OIR. B. Appeal the WIR's decision, arguing that investment policies are unnecessary during the formation stage. C. Delay submission of the business plan until the captive has been operational for 1 year. D. Reduce the scope of the captive to bypass the capital requirements. Answer: A. Adjust the business plan to include a detailed investment policy and submit proof of adequate capital to the OIR. Explanation: A. This is correct because Florida law requires a comprehensive business plan including investment policies and compliance with minimum capital requirements for licensing. B. Appealing without addressing deficiencies would likely result in a denial of the application. C. Delaying submission violates Florida's statutory requirements for captive approval. D. Reducing the scope to avoid capital requirements is not permissible and does not align with statutory guidelines. Relevant law. Chapter 628 Florida statutes mandates detailed investment policies in compliance with capital requirements for captive formation. Question 3. Topic: Reinsurance and alternative risk transfer. A captive insurance company decides to purchase stop-loss reinsurance. What is the primary advantage of this type of reinsurance? A. It provides coverage for losses exceeding a specific limit on a per-claim basis. B. It protects against aggregated losses that surpass a predetermined threshold. C. It allows the captive to transfer all of its risks to the reinsurer. D. It eliminates the need for the captive to maintain reserves for large losses. Answer: B. It protects against aggregated losses that surpass a predetermined threshold. Explanation: A. This describes excessive loss reinsurance, not stop-loss reinsurance. B. Correct. Stop-loss reinsurance covers aggregated losses exceeding a certain threshold, providing financial stability to the captive. C. No reinsurance agreement transfers all risks. A captive retains some exposure. D. Reserves are still required for potential losses, even with reinsurance. Relevant rule: stop-loss agreements are a critical risk transfer mechanism ensuring solvency while enabling captives to manage aggregated loss exposures effectively. Question 4. Topic: Financial management of captive insurance. A captive insurance company is evaluating its investment strategy. Which of the following BEST aligns with statutory requirements and sound financial management principles for captives in Florida? A. Investing all assets in high-risk securities to maximize returns for the company. B. Diversifying investments across various asset classes with a focus on liquidity and risk mitigation. C. Allocating a majority of funds to speculative ventures as captives are not regulated like traditional insurers. D. Maintaining all reserves in cash to avoid market risk. Answer B. Diversifying investments across various asset classes with a focus on liquidity and risk mitigation. Explanation A. High-risk securities can jeopardize solvency and fail to comply with Florida regulations. B. Correct. Florida statutes and best practices require captives to adopt diversified, risk-averse investment strategies to maintain financial stability. C. Speculative ventures conflict with statutory guidelines and sound financial management. D. Holding all reserves in cash avoids market risk but limits returns and fails to optimize asset allocation. Relevant rule: Florida statutes mandate that captives adopt prudent investment policies to balance risk and liquidity while ensuring solvency. Question 5. Scenario-based question. Topic: Governance and ethics. Daniel is the CEO of a group captive and is also a significant shareholder in one of the service providers contracted by the captive for actuarial services. During a board meeting, this relationship is not disclosed and the service provider is awarded a lucrative long-term contract. What ethical action should Daniel take to align with governance best practices? A. Resign from his role as CEO to avoid a conflict of interest. B. Disclose his interest in the service provider to the board and recuse himself from the decision-making process. C. Allow the board to decide without disclosure since the contract benefits the captive. D. Ensure the service provider delivers excellent work to justify the contract, avoiding disclosure. Answer B. Disclose his interest in the service provider to the board and recuse himself from the decision-making process. Explanation A. Resignation is unnecessary if proper disclosure and recusal occur. B. Correct disclosure and recusal are essential ethical practices to avoid conflicts of interest and ensure transparency. C. Failure to disclose violates governance principles and risks regulatory scrutiny. D. Justifying the contract without disclosure undermines ethical standards and exposes the captive to liability. Relevant rule: Florida governance laws emphasize transparency, ethical management, and avoidance of conflicts of interest in captive operations. Question 6. Topic: Florida captive insurance regulations. Which of the following is a statutory requirement for forming a captive insurance company in Florida? A. Conducting a feasibility study and obtaining an actuarial opinion. B. Filing quarterly financial statements only during the first year of operation. C. Operating without regulatory oversight for the first 3 years. D. Submitting audited financial statements every 2 years. Answer A. Conducting a feasibility study and obtaining an actuarial opinion. Explanation A. Correct. Florida law requires a feasibility study and actuarial opinion to ensure the captive's financial viability. B. Financial reporting requirements are annual, not quarterly. C. Captives are subject to regulatory oversight from inception. D. Annual, not biennial, audited financial statements are required under Florida regulations. Relevant rule: Chapter 628 Florida statutes outlines licensing and reporting requirements for captives, including feasibility studies and actuarial opinions. Question 7. Topic: Emerging trends in captive insurance. Which of the following describes the primary benefit of adopting a protected cell company (PCC) structure in captive insurance? A. Increased operational flexibility by eliminating the need for separate financial records for each cell. B. Segregation of assets and liabilities within individual cells, protecting them from the risks of other cells. C. Reduced regulatory oversight compared to traditional captives. D. Higher return on investment due to risk pooling across cells. Answer B. Segregation of assets and liabilities within individual cells, protecting them from the risks of other cells. Explanation A. Financial segregation is mandatory and cannot be eliminated. B. Correct. The PCC structure ensures that the assets and liabilities of one cell are legally insulated from others, a key advantage. C. PCCs are subject to the same regulatory oversight as traditional captives. D. Return on investment is not directly linked to the PCC structure. Relevant rule: Protected cell companies are governed by statutory provisions that enforce strict segregation of risks and assets. Question 8. Scenario-based question. Topic: Reinsurance and alternative risk transfer. Rebecca's captive has suffered significant losses from a series of hurricanes exceeding its reinsurance coverage limits. To stabilize the captive's operations, Rebecca considers purchasing stop-loss reinsurance for the next policy year. What key factors should Rebecca prioritize when negotiating the stop-loss reinsurance agreement? A. Ensuring the reinsurer has a rated financial strength by a recognized rating agency. B. Setting the attachment point to equal the captive's annual premium revenue. C. Selecting a reinsurer based on the lowest premium cost regardless of financial strength. D. Avoiding stop-loss coverage as it is unsuitable for weather-related risks. Answer A. Ensuring the reinsurer has unrated financial strength by a recognized rating agency. Explanation A. Correct. Financial strength ensures the reinsurer can meet its obligations, a critical consideration for risk mitigation. B. Attachment points should align with the captive's risk tolerance and loss history, not its premium revenue. C. Cost is important, but financial stability of the reinsurer is paramount. D. Stop-loss reinsurance is suitable for aggregated weather-related losses. Relevant rule: reinsurance agreements should prioritize counterparty risk, with financial ratings serving as a key indicator of reliability. Question 9. Topic: Legal and tax considerations. Which IRS guideline governs the recognition of a captive insurance company for tax purposes? A. IRS Notice 2016-66. B. IRS Code Section 831. B. C. IRS Code Section 482. D. IRS Notice 202015. Answer B. IRS Code Section 831. B. Explanation A. Notice 2016-66 addresses micro-captive arrangements but does not govern tax recognition. B. Correct. Section 831. B. Governs the taxation of small captive insurance companies, providing favorable tax treatment if criteria are met. C. Section 482 deals with transfer pricing, not captives. D. Notice 202015 pertains to health plans unrelated to captives. Relevant rule: IRS Code Section 831b outlines qualifications for small captives and associated tax benefits, requiring compliance to avoid recharacterization of premiums. Question 10. Topic: Practical applications of captive insurance. Weighs the primary advantage of a multinational captive insurance program for global corporations. A. Simplified regulatory compliance due to uniform global laws. B. Centralized risk management across multiple jurisdictions with potential cost savings. C. Avoidance of local taxes on premiums in all domiciles. D. Elimination of the need for fronting arrangements. Answer B. Centralized risk management across multiple jurisdictions with potential cost savings. Explanation A. Regulatory compliance remains complex due to varying local laws. B. Correct. Multinational captives centralize risk management and optimize costs across global operations. C. Local taxes may still apply depending on the jurisdiction. D. Fronting arrangements are often required in jurisdictions lacking captive recognition. Relevant rule: multinational captives leverage economies of scale while adhering to jurisdiction-specific regulations to streamline risk management. Question 11. Topic: Captive licensing requirements. In Florida, what is a key component required to obtain a license for a captive insurance company? A. A minimum of $100,000 in capital and surplus for all types of captives. B. A detailed feasibility study demonstrating the proposed captive's ability to meet obligations. C. An exemption from submitting a business plan to the Office of Insurance Regulation. D. A 3-year deferral period before audited financial statements are required. Answer B. A detailed feasibility study demonstrating the proposed captive's ability to meet obligations. Explanation A. Minimum capital requirements vary by type of captive. B. Correct. A feasibility study is crucial to ensure the viability and regulatory compliance of the captive. C. A business plan is mandatory as part of the application process. D. Audited financial statements are required annually starting from the first year of operation. Relevant rule: Chapter 628 of the Florida statutes outlines the application and licensing requirements for captives, including the need for feasibility studies. Question 12. Topic: Risk management strategies. Which risk management technique is commonly used by captives to handle unpredictable losses? A. Retaining all risk to reduce costs. B. Transferring high-severity risks through reinsurance arrangements. C. Investing surplus funds solely in equities for higher returns. D. Eliminating risk through comprehensive hedging strategies. Answer B. Transferring high-severity risks through reinsurance arrangements. Explanation A. Retaining all risks increases financial exposure. B. Correct. Captives use reinsurance to manage catastrophic or high-severity risks while retaining predictable ones. C. Surplus investment must balance risk and compliance. Equities alone are too volatile. D. Comprehensive hedging is not a primary strategy for captives. Relevant rule: effective captive risk management balances retention with strategic reinsurance to mitigate excessive losses. Question 13, scenario-based question. Topic: Tax considerations. A Florida-based captive receives $2 million in annual premiums and elects to be taxed under Section 831(b). However, during an audit, the IRS determines that the captive is inadequately capitalized and not operating as a legitimate risk transfer mechanism. What is the likely consequence for the captive? A. The captive will lose its tax-exempt status permanently. B. Premium payments will be reclassified as taxable income for the parent company. C. The IRS will impose penalties but allow the captive to retain its Section 831(b) status. D. The captive's operations will be shut down immediately. Answer: B. Premium payments will be reclassified as taxable income for the parent company. Explanation: A. Tax-exempt status may be reinstated if compliance is corrected. B. Correct reclassification as taxable income is a common penalty for failing to meet Section 831(b) requirements. C. The captive may lose its Section 831(b) status entirely, not retain it. D. Shutdown is not an automatic penalty but may occur if violations persist. Relevant rule: Section 831(b) requires compliance with capitalization and operational criteria to maintain favorable tax treatment. Question 14. Topic: Captive types and structures. What is a distinguishing feature of a risk retention group RG compared to other captive insurance companies? A. ROGS are exempt from all state insurance regulations. B. ROGS can write liability insurance for their members across state lines. C. ROGS can provide property insurance to unrelated entities. D. RRGS are limited to single-parent ownership structures. Answer: B. RRGS can write liability insurance for their members across state lines. Explanation: A. RRGS must comply with the regulations of their domiciliary state. B. Correct. RRGS are authorized under federal law to write liability insurance across multiple states. C. RRGS are restricted to liability insurance, not property insurance. D. RRGS can have multiple member ownership. A relevant rule: RRGS are governed by the Liability Risk Retention Act, enabling them to provide liability coverage nationwide. Question 15. Topic: Governance in captive operations. What is a key responsibility of the board of directors for a captive insurance company? A. Managing day-to-day underwriting activities. B. Establishing and reviewing the captive's risk management policies. C. Eliminating the need for third-party audits. D. Setting premium rates based on market trends without actuarial input. Answer: B. Establishing and reviewing the captive's risk management policies. Explanation: A. Day-to-day management is handled by operational staff. B. Correct. The board oversees governance, including risk management policies, to ensure compliance and effectiveness. C. Third-party audits are mandatory under most regulations. D. Premium rates must be actuarially determined. Relevant rule: effective governance requires oversight and strategic policymaking rather than operational involvement. Question 16. Scenario-based question. Topic: Claims management. A Florida-based captive insurance company receives a claim from its parent company for business interruption due to a cyber attack. The captive's policy excludes cyber risks, but the parent company argues that business interruption should still apply. What is the captive's appropriate course of action? A. Deny the claim based on the exclusion clause in the policy. B. Pay the claim to maintain goodwill with the parent company. C. Request an amendment to the policy to include the claim retroactively. D. File for regulatory approval to cover the claim despite the exclusion. Answer: A. Deny the claim based on the exclusion clause in the policy. Explanation: A. Correct. Policy exclusions must be upheld to maintain contract integrity. B. Paying the claim would breach policy terms and regulatory compliance. C. Retroactive amendments are not permissible in insurance contracts. D. Regulatory approval does not allow coverage for excluded risks. Relevant rule: insurance policies must be applied as written with exclusions enforced to avoid legal and regulatory issues. Question 17. Topic: Captive reporting obligations. How often must a Florida-domiciled captive submit an actuarial opinion to the Office of Insurance Regulation? A. Semi-annually. B. Annually. C. Every 2 years. D. Only upon request by the regulator. Answer: B. Annually. Explanation: A. Semi-annual submission is not required. B. Correct. Annual actuarial opinions ensure ongoing compliance and solvency. C. Biennial submission is insufficient for regulatory purposes. D. Regular submissions are mandatory, not just upon request. Relevant rule: Florida regulations require annual actuarial opinions to maintain transparency and oversight. Question 18. Topic: Solvency and reserve management. What is the primary purpose of reserves held by a captive insurance company? A. Maximizing investment returns for the parent company. B. Ensuring funds are available to pay future claims. C. Reducing the need for reinsurance arrangements. D. Avoiding regulatory penalties for underfunding. Answer: B. Ensuring funds are available to pay future claims. Explanation: A. Investment returns are secondary to claims paying ability. B. Correct. Reserves provide financial security for policyholder obligations. C. Reserves complement reinsurance but do not replace it. D. Compliance is a consequence, not the primary purpose. Relevant rule: adequate reserves ensure solvency and policyholder protection. Question 19. Topic: Regulatory compliance. Which office oversees captive insurance companies in Florida? A. Department of Financial Services. B. Florida Office of Insurance Regulation. C. National Association of Insurance Commissioners. D. Federal Insurance Office. Answer: B. Florida Office of Insurance Regulation. Explanation: A. DFS oversees broader financial activities, but not captives specifically. B. Correct. The Florida OIR regulates captive insurance companies. C. NAIC provides guidance but does not oversee state captives. D. The Federal Insurance Office does not regulate captives. Relevant rule: captives in Florida are directly regulated by the OIR under state statutes. Question 20. Topic: Types of captive insurance companies. What is the primary difference between a single parent captive and a group captive? A. A single parent captive insures only the parent company's risks, while a group captive insures the risks of multiple unrelated entities. B. A single parent captive insures multiple companies, while a group captive insures only one company's risks. C. A single parent captive must be domiciled in the parent company's home state, while a group captive must be domiciled in a foreign jurisdiction. D. A single parent captive can only provide property insurance, while a group captive can offer both property and casualty coverage. Answer: A. A single parent captive insures only the parent company's risks, while a group captive insures the risks of multiple unrelated entities. Explanation: A. Correct. A single parent captive is owned by one entity, while a group captive is a collective of unrelated entities coming together to insure their own risks. B. This is the opposite of the correct distinction. C. Both types of captives can be domiciled in various locations based on regulatory preferences. D. Captives can write various types of insurance, not limited by ownership structure. Relevant rule: captive structures vary based on ownership, with single parent captives focused on ensuring the risks of a single entity and group captives ensuring risks for multiple entities. Question 21. Topic: Risk management and premium calculation. Which factor most directly influences the premium rates for a captive insurance company? A. The current state of the broader insurance market. B. The parent company's financial performance and solvency. C. The captive's claims history and loss experience. D. The regulatory requirements in the domicile state. Answer: C. The captive's claims history and loss experience. Explanation: A. While the broader market affects pricing, the captive's own loss experience plays a more direct role in premium calculation. B. Financial performance is relevant to the captive's ability to meet obligations but does not directly influence premium pricing. C. Correct. A captive's claims history and loss experience are primary determinants in pricing premiums, reflecting the risks it has already experienced. D. Regulatory requirements affect solvency and compliance but not directly pricing decisions. Relevant rule: premiums are often calculated based on the loss experience, underwriting performance, and risk management strategies of the captive. Question 22. Scenario-based question. Topic: Risk transfer. A captive insurance company has been insuring the risks of its parent company, which operates in both manufacturing and retail sectors. The manufacturing division has experienced several losses over the past year, while the retail division has been profitable. To maintain the sustainability of the captive, the company's risk manager recommends separating the two divisions' risks and establishing separate captives for each. What is the most likely reason for the recommendation? A. To comply with state regulations that require separate captives for each line of business. B. To allocate risk more appropriately and reduce the impact of losses from one division on the other. C. To take advantage of tax breaks associated with having multiple captives. D. To ensure that the retail division can continue to write business while the manufacturing division is underperforming. Answer B. To allocate risk more appropriately and reduce the impact of losses from one division on the other. Explanation A. State regulations do not require separate captives unless there is a specific risk or operational reason to do so. B. Correct. Segregating risks allows each division to manage its own risk profile without one division's losses negatively affecting the other's financial stability. C. Tax breaks are not a primary reason for creating multiple captives. The focus is on risk management. D. Separate captives could allow continued operations but would not necessarily ensure the retail division's ongoing viability if risks are not properly managed. A relevant rule: captives are often structured to isolate different types of risk, ensuring that poor performance in one area does not undermine the entire operation. Question 23. Topic: Captive reinsurance. What is the most common reason a captive insurance company would purchase reinsurance? A. To decrease the capital required to maintain its insurance license. B. To transfer some of the risks of catastrophic losses to another insurer. C. To avoid the risk of paying out claims directly to policyholders. D. To increase the profitability of the captive by reducing claims payments. Answer B. To transfer some of the risks of catastrophic losses to another insurer. Explanation A. Reinsurance does not typically impact capital requirements directly. B. Correct. Captives use reinsurance to mitigate exposure to large, catastrophic losses that could exceed their ability to pay claims. C. Reinsurance does not eliminate the need for the captive to pay claims, it only helps manage larger or unexpected losses. D. Reinsurance helps mitigate large losses, but it does not directly increase profitability by reducing claims payments. Relevant rule: reinsurance is a risk management tool that helps captives share or transfer risks, particularly for large or unexpected events. Question 24. Topic: Captive solvency. Which action can a captive insurance company take to ensure it remains solvent in the event of significant claims payouts? A. Reduce the scope of coverage for its policyholders. B. Increase premium rates for policyholders across the board. C. Diversify its investment portfolio to include high-risk, high-return assets. D. Maintain adequate reserves and secure reinsurance for large losses. Answer: D. Maintain adequate reserves and secure reinsurance for large losses. Explanation A. Reducing coverage may not solve solvency issues and could affect the captive's credibility. B. While increasing premiums might help, it does not guarantee solvency without appropriate reserves. C. High-risk investments could undermine the captive's ability to cover claims. D. Correct. Adequate reserves and reinsurance help ensure that the captive can handle large claims without compromising its financial stability. Relevant rule: captives must maintain reserves and consider reinsurance arrangements to ensure long-term solvency and meet regulatory requirements. Question 25. Topic: Captive company ownership structures. Which ownership structure is most commonly associated with a protected cell captive insurance company (PCC)? A single parent company that owns multiple captive cells. B. Multiple unrelated entities, each owning a separate cell within the captive. C. A parent company with multiple risk management divisions owning individual cells. D. A state government owning several protected cells to manage public sector risks. Answer B. Multiple unrelated entities, each owning a separate cell within the captive. Explanation A. Single parent captives are not typically associated with protected cells. B. Correct. PCCS are designed for multiple unrelated entities to share a single captive while segregating risks into separate cells. C. Cells are not typically divided by internal divisions, but by separate entities in PCCS. D. State-owned PCCS are less common, and PCCS are typically used in the private sector. A relevant rule: a protected cell captive allows for multiple entities to share infrastructure while keeping their risks and assets separate within individual cells. Question 26. Topic: Captive insurance regulations. Which of the following is a requirement for forming a captive insurance company under Florida law? A. The captive must have a minimum surplus of $1 million. B. The parent company must provide an actuarial report for all captives. C. The captive must be able to prove it has enough capital to write the anticipated premium. D. The captive must only insure risks for the parent company, excluding unrelated entities. Answer C. The captive must be able to prove it has enough capital to write the anticipated premium. Explanation A. What Florida requires captives to maintain surplus capital. The specific minimum depends on the type of captive. G. Single parent or group captive. B. An actuarial report is often required but is not a universal requirement for all types of captives. C. correct. Florida law mandates that captives must prove sufficient capital and surplus to ensure they can cover their liabilities and write the expected premium. D. Captives can insure risks for both related and unrelated entities depending on their structure. G. Group captives can insure multiple entities. Relevant rule. Florida Captive Insurance Act outlines the capital and surplus requirements for captives, ensuring their ability to meet claims and regulatory standards. Question 27. Topic: Financial management of captives. Which accounting method is typically used by captive insurance companies to prepare their financial statements? A. Generally accepted accounting principles (GAAP). B. International financial reporting standards (IFRS). C. Statutory accounting principles (SAP). D. Fair value accounting. Answer: C. Statutory accounting principles (SAP). Explanation: A. GAAP is used by traditional insurance companies but is not the standard for captive insurance. B. IFRS may be used for global financial reporting but is not typically the standard for captives in Florida. C. Correct. Captive insurance companies use statutory accounting principles (SAP) to comply with state insurance regulations, focusing on solvency and liquidity rather than profitability. D. Fair value accounting is more applicable to investments but is not used for the overall financial reporting of captives. Relevant rule. Captives are required to prepare financial statements according to SAP, which ensures that their financial position remains stable and meets regulatory requirements. Question 28. Scenario-based question. Topic: Captive management and governance. John, the CEO of a multinational corporation, is considering setting up a captive insurance company to cover the risks of its various global subsidiaries. However, he is concerned about the complexity of managing risks in multiple jurisdictions, the different regulatory requirements, and ensuring that the captive is compliant with both local and international laws. What should John do to ensure that the captive complies with regulatory requirements and effectively manages the global risks? A. Set up the captive in a jurisdiction with the least restrictive insurance laws and rely on the local regulatory environment. B. Hire a team of experienced captive managers and legal advisors with knowledge of international regulations to handle compliance and risk management. C. Form the captive in a foreign jurisdiction that requires the least capital and premium requirements. D. Limit the captive to insuring only the risks of the parent company and its immediate subsidiaries, avoiding international risks. Answer: B. Hire a team of experienced captive managers and legal advisors with knowledge of international regulations to handle compliance and risk management. Explanation: A. While cost-effective, selecting a jurisdiction solely based on ease of regulation could expose the captive to potential regulatory risks and non-compliance issues. B. Correct. By hiring experienced captive managers and legal advisors, John ensures that the captive is structured correctly, compliant with local and international regulations, and manages risks effectively across multiple jurisdictions. C. Choosing a jurisdiction based on minimal capital and premium requirements could expose the company to solvency risks and regulatory scrutiny. D. Limiting the scope of the captive could reduce its effectiveness in managing the risks of a multinational company. Relevant rule. Multinational captives require careful governance and regulatory compliance across jurisdictions. Captive managers and legal experts help ensure proper risk management and adherence to both local and international laws. Question 29. Topic: Reinsurance and alternative risk transfer. What is the primary benefit of a captive insurance company entering into a reinsurance agreement? A. To reduce the financial exposure to catastrophic claims. B. To increase the amount of premiums collected from policyholders. C. To avoid the payment of claims to third-party insurers. D. To expand the scope of coverage provided to policyholders. Answer: A. To reduce the financial exposure to catastrophic claims. Explanation: A. Correct. The primary reason for purchasing reinsurance is to transfer a portion of the risk of large or catastrophic losses to a reinsurer, reducing the captive's financial exposure. B. Reinsurance does not directly affect the amount of premiums collected from policyholders. It relates to risk management. C. Reinsurance helps share the risk but does not eliminate the need for the captive to pay claims to its policyholders. D. Reinsurance does not directly expand coverage, but it can make it more financially feasible to offer broader coverage by sharing risk. Relevant rule. Reinsurance is used by captives to mitigate the impact of large, unpredictable losses, ensuring they have the financial capacity to meet obligations. Question 30. Topic: Taxation of captives. How are captive insurance companies typically taxed under U.S. federal law? A. Captive insurance companies are taxed as regular commercial insurers with no special tax considerations. B. Captive insurance companies are taxed based on their investment income with tax deductions for losses paid out to policyholders. C. Captive insurance companies can elect to be taxed under the federal income tax rules for insurance companies but must comply with the IRS Notice 2016-66. D. Captive insurance companies are exempt from federal income tax because they are self-insuring their own risks. Answer: C. Captive insurance companies can elect to be taxed under the federal income tax rules for insurance companies, but must comply with the IRS Notice 2016-66. Explanation: A. While captives are generally taxed like traditional insurers, they must comply with specific rules, especially regarding risk distribution and tax deductions. B. Captives are subject to tax laws, but they cannot simply deduct all losses paid out to policyholders without meeting specific criteria. C. Correct. Captives can elect to be taxed as insurance companies, but they must follow IRS guidelines, such as those found in IRS Notice 2016-66, to ensure they are not classified as tax avoidance entities. D. Captives are not exempt from taxes and must comply with federal tax rules, including specific rules for insurance companies. Relevant rule: IRS Notice 2016-66 outlines specific guidelines for captives seeking to qualify for favorable tax treatment, ensuring they meet the requirements for risk distribution and business purpose.